Hi everybody. Now it's already starting the Q2 of 2022. So thanks for the support in the first quarter, and I have some answers to the queries that posed to me with some comments. Thank you so much for that. So this video we will dedicate it to the earlier retirement and enjoy life earlier, and how to pick it and our details calculations. So Mr. and Mrs. Lau, walk in the peak in Hong Kong, and they say to each other, we have experienced a pandemic, COVID, and also the SARS. So life is so short and unpredictable. So why we have to suffer anymore if we have enough wealth to enjoy? Why don't we just retire earlier? So they tell me she would like to see more clearly how we calculate the financial independence duration so that they can infer their retirement age, and they want to know the concept and rationale behind. So yeah, I say fine, why not? And if you have the patience to digest the number, why not? Okay, so let's see. So we have to lay out all the personal asset and liability into a table. So to calculate the market value of the assets that you own and also the cash flow you have in a year. So you see the numbers in the table. We have several common assets. So we have to determine the maximum loss that one can tolerate in the worst case scenario, so that we will know, we work back, so we will know the market value of each asset class, so that you can have the first asset allocation form, and you know the value of market value of your assets and the cash flow. And the yield of each asset, the total return of the asset, you also need to have a number in order to estimate the cash flow. Then in our case of Mrs. and Mr. Lau, they have salary income, they have equities, they have fixed income, and a home with mortgage. So just seeing the market value, maybe you see the couple is in a good financial condition, but we have to alert you that you also need to see the net cash flow, because the recent example is the China property developers. If you look at the market value of the property they own, it's big, and when you see it together with the cash flow because of the debt payment, and they are on the edge of the financial cliff. So we have prepared 1 million cash in this example in case property value drop and the bank demand top up of the collateral for their mortgage loan. So in this lovely sunny day, the couple have wondered, is it cash flow so important, even more important than asset value? As I said, yes, it is. Just positive market value of your asset aggregate is not necessarily equal to a good financial condition. You need to also check the net cash flow. That is a very important concept. Now let's see the financial independency duration calculations. Okay, so we will see the liabilities. You lay out each type, and the first item is always insurance payment for your health insurance, life insurance, your property, your flat, your car. So we do not calculate the saving element for your life insurance or health insurance. You may add it back in the end when at the retirement age together with the pension fund that you receive. The mortgage payment now is a fixed amount, we assume it, yet the market value of the property is not. When the property cycle is turning down, you could be in a stage of negative asset. That means the mortgage value is larger than the market value. So in a strict sense, people always say owning a property with mortgage is not exactly you own an asset. So we need to see the net asset value at current market price and also your mortgage payment capabilities. There is a possibility that someone cannot afford to pay the mortgage loan, and it just happened in a financial and social crisis situation. The consequence will be the bank will foreclosure the property, and after even they sold the property, someone may still own the bank the money just because of the current market price of the property is lower than the mortgage amount. So this is a very important concept. People who lost their whole life saving, unfortunately, during this extreme situation, but it happened before, and we see this going to happen, soon for a lot of people. Okay, so with this asset and liability, then you get the net asset value and the net cash flow. So if you are not satisfied with this number, you can play around to adjust your asset weightings in your asset allocations, and also think seriously about the absolute loss limit. Okay, so before we calculate the financial independence duration after retirement, we take the following assumptions. Full payment of mortgage, no government tax to pay. We will freeze all the yield and burden growth assumptions. No salary income after 10-20 years. And we're assuming that higher wages and higher return on asset can offset the effect of inflation. So in this example, the estimate of the asset value after 10 and 20 years should differ from the actual value, yet it shouldn't have too big an impact on the FID estimate. Okay, now let's see the results of the financial independence calculations. So we have two scenarios, after 10 years scenario, after 20 years scenarios. So in both scenarios, so the career income will become 0, mortgage payment will become 0, government tax we assume no need to pay, as we said in the assumptions. So what you get is obviously after stop working for salary income earners, they will have a net negative cash flow, 2,300 in our example. So in these two scenarios, so what is our calculations is the financial independence can last 27 years if the couple work for another 10 years, and if they stop working after 20 years, their financial independence can last for 33 years. How we get that? Because we break it down into the cash savings and the financial assets. So then we get the total FID in number of years. So from cash, we see they can last 6.3 years in the 10 years scenario and 20.2 years for the financial assets. So we can see they can last 27 years. And in the case of work only after 20 years before retirement, so the number is not pretty good that they can have a total of 33 years of financial independence. So what it means, when we use it in this example, now the couple is 40 years old, so it means 10-year scenario, they will retire at 50, and they will spend all their cash and financial asset at the age of 77. In the case of 20 years, they can last until they are 95 years old. So you can predict that what is a comfortable retirement age from this exercise. Of course, you can add more complexity and make it closer to the reality. And after they spend all their financial assets and cash, actually, they can still use the reverse mortgage to have the daily expense taken care of, at a very old age. So people also say, I'm very risk averse now, so what should I do? I say you shouldn't force yourself to invest in a short period of time. You should just stay on cash, on short-term bonds, and focus on the property until your investment conviction back, then you can get back to the risk market. But aware that high risk, high return, so maybe during this year or so, you will reduce the number of years of your financial independence duration. Yeah. Okay. So this is a more detailed explanation of how we do the exercise of calculating the financial independence duration. This is the first video in the Q2 of 2022. All our video in the Q1 2022 can be accessed easily through our company website. We have video links there, so you can easily link to all the video and rewatch it. Let us know your comment. Thank you so much.